Welcome, BI Norwegian Business School. I will start time as soon as a member of your team begins speaking. You will receive a 1-minute warning and time will end precisely at 10 minutes. Please feel free to begin.
Good afternoon from BI Norwegian Business School. We are here to present our buy recommendation for Vestas with a target price of 1,480 Danish kroner and a 23% upside. We believe the market has underappreciated the following three key catalysts: Vestas' technological moat, which unlocks a higher pricing potential, its offshore expansion maximizing shareholder returns, and its unique position to capitalize on the renewable transition. Vestas is a global leader producing premium wind turbines along with service solutions. Its business is divided into three segments: onshore, offshore, and services. By the end of 2020, Vestas had a solid order backlog, 3 times its annual revenues. Vestas distinguished itself by having the longest vertically integrated value chain, covering everything from turbine design to plant optimization. Operating in the wind energy industry, Vestas is by default contributing to a more sustainable future. Vestas is also outperforming its peers in many dimensions of each of the E, S, and G. With the environment, Vestas traces all the waste generated by its turbine and its ecological impact at each individual site, versus competitors who only evaluate impact per product line. Regarding the social aspect, Vestas is one of the safest wind turbine manufacturers in the industry, with no reported fatalities in 2020 compared to 3 fatalities reported by Siemens Gamesa. Vestas' governance structure represents the highest Scandinavian standard. With an experienced board and management team, we're confident that the company will deliver best value to its shareholders. With a combined sustainability score of 3.2 out of 4, we found only minor improvement areas and believe Vestas' superior ESG performance will continue to attract ESG-conscious investors. Erlend will now elaborate more on our investment thesis.
We believe the market is undervaluing Vestas' technological moat. Vestas consistently spends more on R&D than its closest competitor, Siemens Gamesa. This creates a positive feedback loop. Higher R&D spending leads to superior technology, which in turn leads to premium pricing. The cycle continues as premium pricing allows Vestas to afford the additional R&D. This cements Vestas' long-term competitive advantage. Vestas' supply chain is moving towards a digital future. With 60% identical components across onshore and offshore turbines and industrial-scale 3D printing, the company has global flexibility. Processing over 100 billion signals per day with predictive analytics, Vestas increases turbine uptime and accurately forecasts energy output. It is also creating utility-scale hybrid solutions. Additionally, investors have overlooked the potential from Vestas' offshore expansion. Offshore is set to become a $1 trillion industry by 2040, and Vestas has already made its move. It recently launched the world's largest wind turbine of 15 megawatts, enough to power 20,000 homes. The turbine is designed with standardized onshore components, and after the recent acquisition of MHI Vestas, the company is now realizing strong synergies from unified onshore and offshore manufacturing. Due to its corrosive environment, offshore turbines require more maintenance. Compared to onshore, where service accounts for 40% of Vestas' operating profit, offshore accounts for close to 60%. Vestas is the only player with unparalleled service and a global service infrastructure, which can therefore exploit this. With these advantages, Vestas is well positioned for a 24% offshore CAGR between 2020 and 2026. We further believe investors have underestimated Vestas' unique position to capitalize on the renewable transition. Trillions are pouring in from governments and corporations to support the sustainable transition. Renewables are set to become 3/4 of the electricity mix by 2050, with wind alone capturing 32% of it. This is because of onshore wind's larger capacity and low levelized cost of electricity. Offshore is also expected to become cheaper than solar over the next decade. Controlling 25% of the market, Vestas' global leadership will be the key to unlocking this energy transition. It outperforms peers through its superior efficiency, highest nominal capacity both onshore and offshore, and best-in-class service. So, with these factors in mind, we believe Vestas is best positioned to capture renewable investments. Sara will now show you how our investment thesis is incorporated in the financial projections.
We project Vestas' revenues to grow at a CAGR of 11% over the next 6 years. Growth will be driven by an increase in deliveries and gigawatts under service. This is a result of increased electrification, green investments, Vestas' tech-enabled services, and its offshore expansion. We also expect Vestas to maintain stable prices, which will further support the revenue growth. We forecast costs to recover quickly after the pandemic, increasing gross margin to 16% in 2026. This is driven by cost reductions coming from supply chain automation, post-acquisition synergies, and input mix optimization. As a result, Vestas will improve its EBITDA margin, reaching 15% in 2026. We expect Vestas to retain its margin leadership due to industry-leading technology. Historically, Vestas has obtained superior profitability compared to peers. We predict this to continue and result in favorable shareholder returns, with EPS growing at 20% CAGR between 2020 and 2026. We therefore expect Vestas to increase dividend payout, reaching 4.8 euros in 2026. We project CapEx to rise as the company expands into offshore. However, this is offset by an increase in operating profitability. With an interest coverage ratio 3.6 times higher than peers, Vestas has solid debt capacity that can readily support its offshore journey. We issue a buy recommendation for Vestas with a target price based on a multi-stage DCF analysis. This model befits Vestas' innovative company profile, allowing us to account for both its aggressive and its stable future growth phase. With cost of capital estimated at 7.1% and terminal growth rate of 3%, we arrive at a target price of 1,480 Danish kroners, which represents a 23% upside. On a positive note, we do see a potential upside for a conservative terminal growth based on the anticipated renewable boom and Vestas' favorable market position. This will result in further share price appreciation far beyond our target price, as seen in the sensitivity analysis. Joe will now expand upon our relative valuation.
Now, to supplement our DCF, we conducted a relative valuation where we compared Vestas to 4 different peer groups: non-Chinese and Chinese wind manufacturers, solar manufacturers, and other green tech companies. We apply a small premium of 10% to Vestas' EV to EBITDA multiple to reflect Vestas' superior ESG and SDG positions compared to its peers, reaching a 2021 EV to EBITDA multiple of 24. This implies a price of 1,507 Danish kroner, a 26% upside, which confirms our buy recommendation. We expect a potential repricing of Vestas, as we believe it should trade at multiples closer to broader green tech companies because of its superior technological leadership. We also conducted a bull and bear case analysis. In our bull case, we determined a price of 1,840 Danish kroner, a 53% upside in which the company fully realizes all synergies between their onshore and offshore segments. Our bear case indicates an 11% drop from its current price, but we believe this is highly unlikely. We also tested our key metrics with a Monte Carlo simulation. We varied WACC, terminal growth rate, megawatts delivered, onshore and offshore selling price, and cost of goods sold. 65% of the scenarios support our buy recommendation, yielding a share price more than 10% above the current price. We identified post-acquisition integration and innovation risk as the 2 greatest risks. Post-acquisition risk can be mitigated by pre-acquisition insight and unified production, and innovation risk can be mitigated through high R&D spending and product flexibility. The other risks were either low probability or low impact. We therefore restate our buy recommendation based on Vestas' technological moat, its offshore expansion, and its ability to capitalize on the renewable transition. For investors looking for a renewable jewel, Vestas is a win-win. Thank you, and we'll now take your questions.
Thank you. Judges, please turn on your video.
Hi, congratulations on the presentation. My first question is about the price movement, because for years, price of the company was between 400 and 600, and in 1 year it doubled. So I wanted to ask you if all the good news that you are projecting for the future are already in the price, especially if it trades at a price to earnings multiple of 40 times or price to book of 7 times, or maybe the good news are going to be so good that this is just the beginning.
Yeah, I can take that. So I think it's definitely more of the good news being the beginning. So Sophie, if you could take us to the peer indices. So we can actually see that Vestas has gone up massively this last year, rising 103%, and then it's slightly down now lately. And I think this is largely because the green investment is starting to materialize. People are seeing that Vestas is the technological leader in this sector. They now have this offshore avenue open for this second revenue stream. And that green investments that are materializing from governments and corporations across the world are really starting to flow into Vestas. But I think this is just the tip of the iceberg. Today, we had a meeting in the White House where they said that they're going to reduce climate emissions by 50% by 2030. And just a couple of days ago, Boris Johnson came out and said they're going to aim for 78% reduction in CO2 emissions by 2030 as well. So you're seeing just these couple of days that huge green investments are materializing, and they're going to be incorporated into the share price over this next year, showing even more upside.
Yeah, and just to add on to that, we still believe that investors have underestimated the technology moat that Vestas possess, and the opportunity of the offshore expansion. In addition to investors have overlooked the unique position that Vestas has on the renewable transition. So we actually state that we believe they should trade at a higher price than the market says right now.
I actually want to build on that question earlier. I agree, with your premise around climate change becoming much more important around the globe, with governments doing more to tackle it, to transition to a sustainable economy. But given this huge interest, what do you think are barriers to entry for this firm? Why can't other competitors, seeing the importance, cannibalize?
Mm-hmm. That's a great question. I can take that. If you go, Sophie, to Porter's 5 forces, you would see that we have done an analysis on the market, and you would see that we don't actually see such a high threat of new entrants, mainly because there are high investment costs that are associated with investing in the best technology on the market. It is also very difficult to replicate all of these turbines, and they require a highly specialized machinery that is on the manufacturing side. To become an OEM, it is quite difficult, and there are quite high barriers of entry. However, what we do see happening is that a lot of the oil giants who want to pivot into renewables, they're entering this market, but they're entering as developers, meaning that they're oversaturating the buy side and becoming actually clients of companies like Vestas.
This is Simon. Thank you for the presentation. In fact, I'm also going to write on the earlier 2 questions as well. In terms of the strength, one of the strengths here, or rather one of the theses that you have, is offshore expansion. And given that offshore represent a very small percentage of the overall revenue contribution, to what extent, or rather, what is the projection of the contribution from this offshore, and how would this be really a theme that is going to propel your proposition?
Sure. Sophie, can you take us to the segment EBIT contribution? Perfect. one of the really surprising things is that Vestas gets the majority of its EBIT contribution from service. You could see that we've projected it in our near-term stage, or first stage in our DCF. And continuing forward, it's going to be between 50 to 45% of EBIT earnings over time. Now, how that relates to offshore is that offshore gives Vestas an additional opportunity to increase service on these offshore turbines that they're going to be placing into the water. Really, in terms of EBIT contribution, the actual parts and the manufacturing of offshore turbines results in very little earnings for the company. It's service, which is really key.
Yeah, and just to add on to that, sort of the offshore market in itself is in its infancy right now. However, there's huge growth projected. Right now, it's sort of small local projects in Europe. Over the next couple of years, we're going to see that expanding to globally. We're going to see it popping up in APEC and in the Americas, and really expanding to these massive scale projects that you haven't really seen so far. So it's going to be a huge revenue stream in the future.
I'll take a question from me. Thank you for the presentation. A very good one. I'll just ask you if you could tell us more about the growth strategy and mainly on acquisitions and synergies over the past years.
Yeah, so if you go to the innovation risk slide, actually, Sophie. Thank you. You would see that basically over the past years, Vestas has made several acquisitions. However, the key ones were like Avalon and Upwind that you can see there in the corner in terms of multi-brand servicing. And right now, the most recent one is MBAU acquisition, which is required for their offshore expansion. However, going forward in the future, we expect that they will mainly rely on organic growth because there are not that many target companies right now in the market, and they're already quite well equipped in order to jump into the offshore expansion with their MBAU acquisition, and they're already equipped with predictive analytics and everything that they need in order to boost their service margins in the future.
Well, I have another question. When you did your comparable analysis valuation, you assigned a 10% premium on the enterprise value EBITDA multiple. So it took it to 24 times. And I was looking at the Chinese companies at 13 times. So my question is, as an investor, how can you convince me not to do a pair trading going short Vestas and long a Chinese company because of this different valuation?
Yeah, I think that's an excellent question. So if you go to the China slide, Sophie. Thank you. So in China right now, they have an OEM structure that relies on very low upfront costs, but very high maintenance costs. And this is only very popular in China. However, in the rest of the world, they're going more for the Vestas model, where they have higher upfront costs, but the total cost, the levelized cost of electricity throughout the entire project is much lower. And what we're seeing is that these Chinese companies aren't really able to go into the rest of the market in terms of the world. They're staying local in China. So their growth potential is mostly domestic. And we're also seeing a trend in this domestic market more towards Vestas' model, which will just lead to further upside for Vestas. So in many ways, these Chinese companies are quite contained in their market, whereas Vestas has this global expansion.
Thank you.
And what would you like? What type of measures or decisions that the company would take would make you change your recommendation?
Sure, I could speak to that. I think one of the triggers where we would change our recommendations if we see Vestas consistently missing some of their offshore targets going forward into the future, if those don't materialize. Additionally, if we see other companies pull ahead in some of their technology offerings, specifically in service, that would also cause us to change our recommendation. However, we stress this in our bull, base, and bear case analysis and determine that Vestas is still in a very strong position, and a lot of these negative triggers are unlikely to materialize.
And if I can add on to that, if we go to the sensitivity analysis slide, you would see that we have actually sensitized the average selling price and the megawatts delivered, for instance, and you would see that it requires like a huge amount of drop in these things, around 15%, in order to change our recommendation to sell. However, we don't think that this is very likely, considering that Vestas has had premium pricing so far in the market, and they have actually delivered quite a lot of megawatts in comparison to their peers.
Yeah, thank you, team.
Time.
Would you be able to walk us?
Time.
Thank you.
Thank you, BI Norwegian Business School.
Thank you very much.
The judges will take a few moments to collect their thoughts and make notes before the next university is brought in.